Welcome back to the Dividend Diplomats YouTube channel, everybody. You know us by now. We are the Dividend Diplomats. Today, I'm going to talk to you about something I just noticed when I was reviewing my portfolio. I'm a little underallocated with REITs. I'm going to talk to you about it. I'm going to share what REITs we own today and what we're going to do about that. How are we going to go about potentially increasing our allocation in the REIT sector?
Guys, before we dive into this big REIT discussion, the real estate investment trust talk, smash that subscribe button, give the diplomats a nice thumbs up as we journey our way to 20,000 subscribers. Very interesting video, very interesting take here, talking about the high flying, wheeling, dealing, girls stealing, kissing. Oh my gosh, here comes Bert the Hurt. Nobody knows what to do. REIT industry.
Can't make a better intro myself there. That's what it's all about. So what about the REITs? You said it, Lanny. What is a REIT? It's a real estate investment trust. Buy property, pay out dividends. People like REITs because in theory, they should be paying a higher dividend yield. They're required by law to pay out about over 90% of their earnings. So they have to pay out a substantial amount of what they earn to keep that REIT status, which is why it typically leads to higher dividend yields. You have to pay it out. That's the purpose of it. With that, a lot of dividend investors, a lot of people that are looking to build a consistent dividend income buy REITs because they like those high dividend yields, but they also like the core investment. REITs can specialize in anything. There are some that are single tenant where they lease out to like your Walgreens, CVS, all those big shopping centers. There's some that own the shopping centers, REITs that are just built towards shopping centers. They're apartment REITs, they're industrial REITs, they're healthcare REITs for all those healthcare facilities. You can have a REIT for anything in any type of property.
You're spot on. And it gives you that great exposure, as Bert said, a little bit of diversification away from just your traditional business model. Essentially, you're being a landlord without being a landlord by owning the REIT industry. You just don't benefit really from the leverage of buying REITs. But Bert, you own some REITs in your account. I think what, 3 or 4 in your Roth account?
I do. And you've been adding a lot more to the REIT sector over the last couple of years than I have. So I haven't. I kind of just set them, forget them. And that's why I'm looking at it here. I own 3 or 4. They only make up about 2% of my portfolio right now. So I'm a little under allocated in REITs. So that's what's kind of bringing me here. Do I want to continue increasing my positions at growing REITs or finding new REITs? That's what we're going to try and solve throughout this video. Which are the 3 REITs that I own? 3.5 is kind of what I'm going to call it. First one is Realty Income, ticker symbol O. Everyone loves Realty Income. They're the monthly dividend paying company. They're a dividend aristocrat. They increase that dividend every quarter, whether it is just a quarter, could be a quarter of a penny. Whatever they do, they pay those monthly dividends and people love them for that. They're the single tenant REIT. They acquired Vera REIT, which owned office space, and then they spun off the office space into its own company, Orion Office, ticker symbol ONL. That's the half I count in my portfolio because I have 10 shares of them. They make up a very, very small allocation. Get back to Realty Income. We own $8,200 of Realty Income. Position produces $381 of income. The yield is about 4.62% today. So that's by far the largest REIT I own. Moving along, we're going to move my wife's portfolio now. Number 1, Iron Mountain, big data center storage. We bought them a long time ago. It's just kind of been set it and forget it. We own $3,700 of Iron Mountain, produces $176 of income, 4.7% yield. Lastly, both of us own Peak Healthcare, ticker symbol Peak, formerly HCP Properties, which is one of the historically best dividend increasing REITs along with Realty Income. And then they kind of went through some change up here. Peak, you sold out of it, Lanny, I believe. I held on to it for some reason. Unbeknownst to me, I still can't remember why, but I told you, I kind of set and forget the REITs. We own 4,085, producing 187 of income at a yield of 4.59%.
There you go. So, over $16,000 worth of REITs producing you $750 at an average yield of about 4.63%, Bert. So what do you think? And at that 2%, do you want to grow your exposure to REITs? Or are you willing to just chill at the 2%?
I want to grow the exposure. I mean, just to keep increasing that allocation. It's a light allocation in the grand scheme of my portfolio. Again, I like it. I like having REITs, having that real estate exposure, to your point, without being a landlord. It's nice, but if I'm going to grow my allocation, what I'm thinking is I'm either I want to get some sectors that I don't own. I don't want to go all in on the single tenant space. I don't want to go all in on data centers. I don't want to go all in on healthcare to become overexposed in one sector that could get crushed by market conditions in the future. I want to try spreading out the love. So that kind of brings me to the next step of this dilemma, Lanny. This is one thing I'm not sure of, and I'm trying to think of how I want to go about it. And we're not going to leave this video with an answer. I'm going to kind of just leave this open. I'd love to get everybody's thoughts on how they're exposed to REITs or what they're doing, and even your thoughts on this, Lanny, because it's kind of a chip off of one of your strategies of what you're doing here. Here's the question, everybody. Drum roll, please. Do I buy an ETF focused on REITs, or do I just buy my own stocks in the sectors I want? That is the question I am still trying to figure out, and I'm still trying to sort through now.
Well, if you don't want to be too involved in any one industry, yeah, Bert, you said you were considering maybe an ETF or an exchange traded fund. Now there's plenty of iShares out there. Vanguard's got a REIT, ETF. What are a few of the tickers of the ETFs that you're evaluating possibly?
That's right. The Vanguard Real Estate Index Fund is VNQ. Their yield is 3.5%. There are two iShares funds that are the big REIT ones out there. There's a core US REIT and then an overall REIT. The core US, ticker symbol USRT, yield 3.13%. Then the US Realty one is ticker symbol IYR. That yield much lower though, 2.65%. And then there's a spider one, the last one, ticker symbol XLRE, the Real Estate Select Sector Spider Fund, ticker symbol, oh yeah, I said it already, it's XLRE with a yield of 3.39%. What's interesting, when you peel back the top 10 holdings of those, they're all pretty much the same. And there are a lot of the companies I'm going to talk about next. A lot of them are the same. It's just how they allocate them amongst the big REITs is what differentiates the two funds.
If you're looking at an ETF, I would go back probably and look at the 3, 5, and 10-year growth rates on the dividend. Not saying which one has a better growth rate on your income, but I would probably look at that, Bert, if you're evaluating the ETFs. Because
that's a good point. That might be another video in and of itself, is which one of these REITs ranks best, kind of what we've done with your Vanguard videos for just overall dividend investing. Why not apply that to the REITs to get a better answer?
Because with that, Realty Income yields 4.6%, which is one of your higher individual REIT that you own. So given that these ETFs are about 1% plus below that, you want to make it up on the growth rate side.
That's right. And that's the pro of the REITs are you get the diversification. The cons are you give up some yield to achieve that diversification. You're trading off at least 1% or 2% of dividend income, but you don't have to think about it. So that's the trade-off. Lower yield, less research, or you can dig in, roll up your sleeves, find the REITs like you have, Lanny, or so many of you other dividend investors out there, and get a higher dividend yield. It just takes more work, more effort, and more monitoring.
Yeah, we're batting pretty well on the REITs that have been acquired.
Yeah, you crushed it with the Store Capital one, though. I mean, it was a great move.
Apartments,
yeah,
APTS.
Yeah, I mean, you're batting well. Maybe I just need to follow you into the REITs. Every time you buy a REIT, I just need to start doing that.
It's the Goldberg. Who's next?
Yeah. All right. So let's put that. The ETFs are an option. We'll put the chart of the 4 ETFs out there again. Now, if I want to go into individual REITs, what's my thought? I still want to buy ones in the same sector. So I'm going to avoid like FRT, another dividend aristocrat that's in a sector I already own. I'm going to avoid the healthcare ones out there. So I know there are a lot of great healthcare REITs out there. We already have Peak. I'm not going to do it. Replacing Peak with one of those might be a different video for a different day. I'm also going to avoid some of the lower yielding ones too, because there are a lot of REITs out there that are just yielding terrible yield. There might be a 1% yielding REIT, 1.5%. And I just don't want that. If I'm going to invest in a REIT, I want the yield. That's the point to me. Buy the REIT, get the dividend yield on top of it. No,
he wants his money and you want it now.
That's darn straight. So what are the sectors I've identified? Industrial, cell phone infrastructure, storage, like gaming, leisure, hotels, and then apartments, which Lanny's pretty familiar with. Lanny's got the apartments one covered.
Man, I tell you what, you've got some big moves to make possibly. So when you're looking at the industry or industrial, you're looking at what? Stag, First Industrial, and Prologis, huh?
Yeah, Stag. And that's the thing. More to come, more detailed analysis to come up later with these. But these are some of the big ones in there that I want to consider. Would love to know if you own them within the sector. Stag is the monthly payer, yields 4.1%. They crush it. You drive by their warehouses all the time. These are huge. They're popping up everywhere, not just for Stag, but the sector. That's why the sector is potentially jumping out to me. Stag yields 4.19%. First Industrial REIT FR yields 2.38%. Prologis PLD owns 2.51%. So you can see only one of them's above the yield of the ETFs. The other two are solid yields, but they're not great by any stretch of the mean. So that's going to be what's interesting as we peel back the layers on that sector.
All about getting that peeler out and start seeing what's underneath the layers, guys. And then obviously from a cell phone, infrastructure standpoint, you got American Tower, AMT, Crown Castle, CCI. Really am big on that. Never made the move into them, but 4.4%, 7% on the Crown Castle, 2.94% on American Tower. Two pretty solid REITs right there.
Yeah, think about what's going on with all the 5G conversions and just getting people access to it. It's a sector that's going to continue playing well within the REITs area. And it's one I clearly don't own because Realty Income, Iron Mountain, and Peak are not in that sector. That's what's kind of jumping out to me there. Obviously, too, the other big one, storage. You drive by them all the time. They're always filled. At least a lot of the ones that are full. The big one, Public Storage, PSA, Extra Space Storage, EXR, Life Storage, ticker symbol LSI, and then CubeSmart, ticker symbol Cube. The funny thing was Public Storage just made an offer for Life Storage, which Life Storage turned down, which means LSI may still be getting acquired by one of the other competitors or by PSA. The yields on this sector as a whole are pretty solid. PSA 3.99%, Extra Space Storage 4.08%, Life Storage, ticker symbol LSI, is 3.91%. Even after the pop after the acquisition announcement, and CubeSmart yield is 4.32%. So it's a sector that's got a nice little premium there to the ETFs.
Yeah, you've got some that are over 4%, which is nice, pretty good complement to where you're currently at, not to steer you in any of those directions. But you're also looking at, gambling and gaming. You've got VICI properties, ticker symbol VICI, and gaming leisure, GLPI. 4, 5, 6%, 5.3%. So a little bit more of a taboo industry. A little bit there actually shut down from the pandemic. But on the side, pretty good yields.
Yeah. And that's the interesting thing. We can go that route too. Last but not least, we have the apartment sector where there's ticker symbol BRT, the Bert one, as I always joke around and say it, Lanny, every time you do that. It would be nice. It'd be a funny one to put in my portfolio. Looking up BRT Apartment Corp's yield. That's what about, why didn't it just pop? Son of a bitch.
About 4.69%.
Too. Their yield is about 4.69%. There's Mid-America Apartment MMA 3.33%. So again, two great options. So looking through this here, hopefully you guys can understand the dilemma, see where it's coming from. You can obviously take all these individual stocks. I can pick them apart here, get higher yields in the ETFs, but those are more stocks to monitor, more REITs to keep on my thing. Is it worth it? Is it not? It might just take the right level of picking.
Have you thought about just owning physical real estate, buying yourself, saving up 10, 20 to 30,000, buying a small duplex house?
I have, but depends. I mean, prices, are they coming down? Interest rates are higher right now. Are the returns there? Repairs, all the fun stuff. I mean, there's the piece of being a landlord on it too. Like that's a piece of it. This has the peace of mind. This has a lot of other things. Like you can sleep at night. That's what it is. I'm not the world's most handy thing for everything. I'm learning, but like if you're not handy, you can't fix a lot of the stuff yourself as a landlord. You have potential costs rising in there every time something goes wrong. So that's the piece to consider too.
All right, man. It seems like you're evaluating it all. Is Fundrise a consideration here, or does that kind of fall outside of this as well?
That falls outside of it. I invest in Fundrise. We have a recurring purchase about 100, 200 every month, I should say, not every week, every month.
Man, going ham.
Yeah, I should have put Fundrise in here because that's another piece of the allocation, but still I want to get my own REITs outside of Fundrise, outside of what I already own going through here.
Seems like a nice debate here, guys. Those that are watching, if you're buying REITs, which ones are you buying right now? If you see Bert's, current REITs that he owns with Realty Income, Iron Mountain, and then, Peak Healthcare, Are you adding to those at these prices, or are you, picking up an ETF instead? Are you selling your REIT individual stocks and moving straight into ETFs? Would love to hear the feedback in the comments.
Yeah, stay tuned. Let me know what other REITs are out there to consider. And Lanny, I realized after going through all this, I left one off that you've been buying. You just made the move with your store capital funds.
Yeah, I threw a couple of dollars on it, right?
Yeah, just a few bips. All right, everyone. So as you know, if you haven't already, subscribe to the channel. Give this video a thumbs up. I can't wait to hear all of your thoughts about the REITs and what you guys are doing within this sector.
Make sure to check out our other videos. And Bert, is there one more message you want to have for the community here?
If you're not with us, you're against us.
That was Bert, the Hurt, and Lanny from the Dividend Diplomats, over and out.